Good morning and welcome to Purpose Driven Finances, where our focus is helping you use your finances to achieve the purpose and plan for your life. And now here's the host of Purpose Driven Finances, Alan Molina with Serwus Capital Management.
Hey, good morning. This is Alan Molina, your host, Purpose Driven Finances, President of Serwus Capital Management. Hope you're having a blessed day, a great weekend, and enjoying the weather. You know, it's a little bit cool down, but I love the daily storms. On Friday, I know you really wanted to know this, but at our home, I've created some roofs to where we just hear the rain. I love hearing rain on a tin roof. Left the office, just went out on the porch and just listened to the rain until we started getting wet. It was a great day. Sitting here with my co-host, Mary. How are you doing?
I'm well. I love the storms, too. I love a thunderstorm at night, kind of wakes you up. And when it's windy, no damage. Of course, you don't want any damage, but just a nice thunderstorm at night. It's just it's just cool.
It is.
Yeah.
It is. And on our back porch, we have a little fireplace and the tin roof and just glorious. Maybe have a hot tea. That's what it's.
That sounds like fall, Alan.
Yeah,
like
exactly.
You're ready for fall.
We're getting ready for fall. But folks, hope you're having a great week. I tell you, the past week and a half, 2 weeks has been exciting in the market. Things in the economy are changing. It's pretty exciting. It makes enjoy these days more than if it's just boring. And so, Mary, what I thought we would talk about today is I want to wrap up this portfolio management series probably in 2 weeks after this week, maybe 3 weeks, but just wrap it up. If we had an hour show or 2 hour show, we could do it quicker. But part of the reason I do this is for content, for social media, but also for the website. Because Mary, I have found that a lot of people enjoy seeing the business card of your website, but they also really like hearing a podcast or information explained. And so that's one reason why I'm going in depth in all these areas. So Mary, today what we're talking about is income growth or total return. Just a little tease, because I really want to talk about a couple subjects beforehand, is a lot of times people will say, hey, I'm a retiree. I need to focus my portfolio on income. Or I'm a young buck. I'm 25, 35, 45, whatever. I'm 55 and I'm still a young buck. So should I only focus on growth? And realistically, you should really focus on total return. And we're going to go into some history, some reasons to do that. Hopefully not get too much into the weeds, but keep it on pace and look forward to that.
So there's some stories that I saw this week, Alan, that are national stories, but I think you're going to put them in perspective as to why local families will care about this. There are two financial stories. At the end of July,
Right.
The U.S. and Japan actually stepped into the currency market together to support the Japanese yen. So the question, of course, is why would the U.S. Treasury care what happens to the Japanese yen?
Well, that's a great question. And the exciting part of it is there's so much to talk about here, but also there's so much in the world that they talk about. There's a lot of pros, cons, and things such as that. The mainstream media, I don't think they understand how wise, how knowledgeable, how intelligent he is, but not only that, how much experience he has of running money. Because Bassett, he's serving Donald Trump, and he is a Republican. Do you know who he used to work for?
Who?
George Soros.
I think I had heard that. Yep.
Now, that is a quandary. And it was like, what's going on? Why are you working for a Republican? And I'm trying to give a little back history.
And George Soros, of course, the supporter of many left backing left causes.
I mean, the dude, yes.
Yeah.
He has caused some issues. And I'm not talking about just on the left. I'm talking about, I think some of the things that they've done is cunning. I haven't liked them, just to be blunt. However, Bassett said that he had not talked to his boss because his boss mainly ran the foundation side, and he a lot of times ran the trading side. So it was two different sides of the coin. And I'm kind of getting over my skis here, but I believe that Besant was, when he was trading at the hedge fund, was responsible for a dramatic shift in the Bank of England to where it had some issues. So he knows currency. Another issue, and we're going to get to the yen. I'm just trying to give people and clients some background as to what's going on. Do you remember a few months ago, I believe he did a currency swap with Argentina? You probably don't remember because it's in the finance arena. What ended up happening is people pitched a fit. I think it was $20 billion. People pitched a fit. And America actually made money from that to help them. And people made a fit. And he laughed and he said, we actually made money. So let's bring it home. Why the yen? Well, July 31st, the U.S. and Japan jointly intervened to support the yen. It was the first joint intervention since 1998. And the U.S. reportedly used euros from the Exchange Stabilization Fund to buy yen rather than selling dollars. Now, you say, well, why is that? Well, one, to make Europe a little bit weaker. They're high and mighty. They continuously snub their nose at America, even though we support so much of what they do. But number two, part of the reason why the yen had to be stabilized is they are the number one holders of U.S. government debt in the world. A lot of times people will say it's China. It's not China. It's Japan. And so in order to support the yen, their realistic expectation would be to sell U.S. government bonds. But what ends up happening is if you sell U.S. government bonds, it causes the bond rates to go up, and it hurts America and hurts all the citizens. So Besant said, you know what? A stable yen matters not only to the region of the Japanese region, but also he did not want the U.S. bond market to get disorderly. Now, what I mean by disorderly is he didn't want rates to be jumping in a significant fashion, which will be, I'm anticipating your next question.
Right. Would it cause higher interest rates here?
Exactly. Mm-hmm. And so what happened is, like I said, they hold about $1.2 trillion worth of U.S. treasuries, and defending the yen funded by treasury sales would have pushed the rates higher. So what ended up happening was Besant, he was protecting America and portfolios and the stock market and everyday impact, mortgage rates, corporate borrowing, dollar, and global risk appetite.
So that was end of July.
End of July.
And then this past week, the Treasury said it's going to at least double planned buybacks of longer-term government bonds. So explain that to us in English.
Right. And I know this is getting deep into the minutia of what I do. One thing, now, once again, I am going to explain a little bit and tell a few stories. The reason they bought long-term treasuries is simply because they were going up in yield, which means they were dropping in value. But the problem of it dropping in value but increasing the yield is, one, the amount of interest expense that they would have. But the other side of the coin is it would cause the interest rates on mortgages, on various other things, to go up that are tied to the yields of a 10, 20, 30-year bond. So why did he do that? Well, one, he wanted to defend the treasury bonds and protect investors, protect the U.S. government. And then I saw some interviews where he said that there was some disconnect between what was reality and what the market was actually doing. Another side story. I don't know if you've heard, Mary, but at night, America is moving 5, 8, 10, 15 million barrels of oil through the Strait of Hormuz. And it's a total disconnect because oil shouldn't be going up. I mean, it's almost at pre-war level that the U.S. military is pushing them through. And so what's happening is he recognized that there's a disconnect. And Mary, I have a lot of data. I have improved the data. I see the data. I see moves. But Scott Besant is at a different level than you and I, than the average financial advisor, the average hedge fund advisor. and he has all the government data. And so what happened is they're going to be buying back, I think, $8 to $8 billion a day or a week or something. I think it's a day, all the way through November 4th. Now, some people will say, November 4th, that's right after the mid-cycle elections. However, we're in the quarterly time frame of the interest rate and buybacks occur. So it's really a date on the calendar, not necessarily right after from a political standpoint. Because a lot of times we're jaded as people and say, you know what, it's really because of a political thing. Now, what happens is the buybacks, they remove older, less liquid bonds, and it reduces pressure on the long end. Now, what ends up happening is Treasury can fund more through short-term bills, often talked about as a Treasury twist. Now, it's not the same as Fed QE. Fed QE is Treasury debt management operation versus central bank balance sheet monetary policy. Because remember, there's the Fed, Federal Reserve, and then there's the Treasury. Bessent is over the Treasury, not the Federal Reserve. And now why do we care? 10 and 30-year yields, they influence mortgages, business financing, federal interest expense, and stock valuations. And so if you have a runaway long-term interest rate, 10, 20, 30-year interest rates going significantly higher, it's going to dramatically affect things, specifically in the stock market. And if you look at the stock market the past 2 months, but realistically the past year, the bond market has been crazy. I've been meeting with clients and been communicating to them that if you just look at various bonds that are out there, what I mean by that is I track about 15 to 20 different asset classes of bonds, and there's only, I think, 3 out of the 15 that actually have made money this year, not accounting for the interest rates that they are paying out. But many of them have a negative return, including the interest rates. And the reason for that is there's a large uncertainty and skepticism around the bond market. And so Bassett says, you know what, we need to protect that. We need to change some things. And at times it's political. So, Mary, I got a couple questions for you.
Okay.
If the 30-year, hopefully you're going to do great. I look forward to it. No math involved.
I should be asking these to you.
If the 30-year rate rises, would you feel it first in your savings account, your mortgage, or business loan? What do you think? I don't expect you to know this. This is a question I would ask a listener. Where do you think you would feel it first?
The mortgage.
Probably mortgage or business loans.
Yeah. Whether you're a homeowner or business, small business, yep.
Now, does the government intervention automatically mean the problem is solved?
No.
Right. So, it's going to have to happen. They're probably going to have to go from $4 or $5 billion, probably double that. I wouldn't doubt it, but they're going to have to raise it up significantly. Now, the next question is that I would want to be asked is, well, is the government going to lose money on that? No, because what they'll do is they'll just put them in the Treasury and let them mature. And then what happens to the money? It just goes right back to themselves. So the interest that they pay it doesn't go to shareholders anymore, not shareholders, but bondholders. It goes directly to their accounts. Now, what happens when the government has to manage several pressures at the same time? It gets complicated and it gets exciting, and you better watch out. So, Mary, we've covered a lot. 2 great questions you had.
Yes.
I appreciate that. Now, what I want to do is let's go to a 30-second break. I wonder if we should do a minute. That way, give people a break. I don't know, because we went deep into the woods. Let's do a minute. And then, folks, what we're going to do is when we come back, we're going to talk about your investments in your portfolio, income versus growth versus total return. Stick around. Give me a call, 434-316-0246, and I'll catch you on the flip side.
Hi, everyone. Brian Kilmeade here. Coming up on the next edition of the Brian Kilmeade Show, we'll have the biggest newsmakers, news breakers, and take a deep dive into news you care about. Whether it's breaking news, entertainment, politics, or sports, even pop culture, I'll bring you the latest developments with expert analysis. But from the big names you know and love. Plus, you never know who may stop by. That's all coming up on the next edition of The Brian Kilmeade Show.
Weekday mornings from 9 to noon on WLNI.
The Vince Show.
Good luck, and you're replacing a man. Maybe he'll be back there someday. But when I heard you got the job, I said they cannot have done better because you are terrific, and you're going to have a great career anyway. So whether you'll be there or someplace else, Vince, you're going to have a great career.
President Donald Trump, the absolute best. Thank you, sir.
Thank you very much.
Weekdays from noon to 3 on WLNI.
The Vince Show.
And now, back to Purpose-Driven Finances. Here's Alan Molina with Serwus Capital Management.
Hey, good morning. Alan Molina again, host of your Purpose-Driven Finances, president of Serwus Capital Management. Hey, do me a favor. Go to wherever you listen to podcasts, pull up Purpose-Driven Finances, download it, check it out. It really helps me. So far this month, we're averaging about 500 downloads. I've been told that's good for a local podcast.
Yeah, it's great.
Just share it. So, folks, give me a call, 434-316-0246. So this segment two, we're talking about is income versus growth versus total return. And the reason we're going down this is it's portfolio management. And I hear often, hey, I'm getting ready to retire. I should go to an income portfolio. But before I ask Mary some questions, I want to give you a couple tidbits, a couple ideas. I'm not going to share the organization because that's just not right. They asked me, the CFO contacted me and said, Alan, we want an income-only portfolio. We want or you tell us about the portfolio. And I gave them a diversified, proper institutional account, which applies to individuals as well, for their portfolio. And the CFO says, you know what, Alan, I don't really like that. I really like an income portfolio. I like to get 8, 9, 10% yield on my investments. And I was like, that's great. And I was actually trying to find the presentation because I keep everything. Couldn't find it. I guess it's on an old computer. And what that CFO was doing was dumpster diving for high yield stocks and ETFs. Now, the problem with that is if something has a very high yield and it's not for a good, reasonable reason, that's not good English, but that's okay.
For a good reason.
For a good reason. Then what's up happening is you have a great yield, but your portfolio goes down. Let me give you another example. Another institution, their financial advisor was saying, hey, I'm getting you 7, 8%. But the CFO came to me and said, Alan, our portfolio is down $700,000, but the advisor said we're getting 7%. And of course, it's a big portfolio if it's down $700,000. And I looked at it, and they were buying new issue preferreds. And you're like, Alan, you're getting into the weeds. A new issue preferred, it was getting 6, 7, 8% per issue. But what happened is, as soon as it starts trading, it drops by 2 or 3%. You do that in a large portfolio, you lose money, even though you're getting a nice yield. So the reason I bring that all up is the traditional instinct is live on the income and never touch principal. It sounds conservative, but it can distort the portfolio towards yield-based. High yield can mean more than credit risk. It can mean concentration, it can mean slower growth, inflation risk. Also, income is only one component of return. Core question, are we managing for a yield number or for your spending needs? And so the reason, and we're going to get into income versus growth versus total return. And Mary, let me ask you a question. If you receive a 6% income check, but the account fell by 10%, did you make 6%?
No.
That's great. A lot of people are like, well, would you rather have a portfolio that pays income or one that reliably funds your life?
The latter.
Exactly. You want one that will meet your goals, your needs, your objectives, not just pays an income. Now, Mary, I want to use Yale as an example.
Okay.
Great. Everybody's heard of it. Not the Yale on the hill over here. Isn't there, don't they call
Harvard on the hill.
Harvard on the, oh, it's Harvard. Harvard on the hill, not Yale on the hill. It's Harvard on the hill. So the Yale. Yale moved from a yield only to a total return in 1967. The real endowment value peaked around 1969, but by 1982, the purchasing power was only about 54% of the level. And the problem was not just returns. Inflation, spending policy, and portfolio concentration all interacted. But here's what happened. In 1977, Yale capped the spending growth to stop eroding real value. And the key there is they realized that focusing a portfolio on income only was a problem. Then in 1982, they invoked a spending policy that smoothed out the rules. It ended up being, I think, if you smoothed it out, it's around 5.25%. And then in 1985, David Swenson arrived and transformed the asset allocation. He did not invent Yale's total return spending concept, but he made it better. And so the key there is more dollars on paper does not mean more purchasing power, because the value of the endowment went up, but the purchasing power went down. Now, a lot of people say it's all because of inflation and things such as that. But realistically, if you look at what happened in 1982 with endowments, when they were focused on income only. Now, Mary, you and I are too young to remember when you could get 19% on a CD. I mean, you may have paid attention to your parents, but realistically, we don't remember those days because it's not something that we did. And so what ended up happening was, if you focus your portfolio only on income, what ends up happening is when the economy changes from an income to a growth perspective, it totally changes. Now, before we get there, I'm jumping ahead. You have to have a quality spending policy, Mary. What I mean by that is I like to say 5% of your portfolio. And the reason I say 5%, it's not a law of mathematics, but it has been tested through actuaries. It comes from the endowment world, that if you spend roughly what the portfolio can earn after inflation and cost over the long run, it preserves the purchasing power for future beneficiaries. And so if you can get a decent return, what I mean by a decent return is 7, 8, 9%. Now, one thing people always tell me, Alan, I've gotten 14% over the past 5 years, or whatever the number is. Bro, sister, my friend, you can't use just the past 5 years because that's not a market cycle. What a market cycle is going from the bottom to the top to the bottom. What I mean by that is it needs to include significant drawdowns like 2007, 8, and 9. Too often what people will do is financial advisors will cherry pick the years in order to show a portfolio. So if you just look at the past 5 years, it's been all nice and glorious. There's been some downturns, but nothing significant. How does the portfolio match to those years of 2007, 8, and 9? Number two, long-term nominal returns minus inflation often lands in the 4 to 5% neighborhood. And so private foundation rules also have popularized the 5%. Now, Yale historically has moved from about 4.5 to 5, sometimes 5.25, just to smooth things out. Now, the author Bengen, Bengen, he came up with a 4% rule. I think that's a little conservative. I like 5% as the max because realistically, your retirement is very similar to an endowment that Liberty University has. Is it the University of Lynchburg? Oh, wow, I got it right. Yep. Amazing. The same endowment that they have. Roanoke College, William and Mary, VCU, Yale, Harvard. Their endowments are just like your retirement. You know, one of the saddest things I've seen in life, Mary, is when a retiree runs out of money. It's horrible. Things have to change.
You've given that statistic about if you hit 60 without any major health concerns, chances are you're going to live a lot longer. Yeah.
And so you have to be prepared for that. So I like 5% because if you can get a decent return over the long haul, 7, 8% average, then 5% is just fine. It's not guaranteed. It's not perfect, but it really is the threshold. Now, I've talked a lot, Mary. You got anything that's come to mind?
Well, you had started to talk about income-focused portfolios versus growth-focused portfolio. Do you want to define those quickly?
Yeah. Income focus is what's my interest rate? What's my dividends? How's that coming into the portfolio? Then the other thing is we have growth focus. That is the return from point A to point B in a year of a stock. They'll say the S&P 500 is up 12%. That's the long-term compounding. The risk is cash flow may require selling during markets. In total return, what that does is it takes into account income, capital appreciation, or growth, and that is the total return of your portfolio. Because realistically, we haven't talked about what you should buy. Guess what we're buying, Mary? We're buying gold. We're buying shiny things, silver. We're buying platinum. We're buying copper. It doesn't shine very much, but it shines a little bit. We're buying steel. The reason being is the U.S. dollar is going down in value. Those things do not produce a dividend or an interest. However, if like we bought some Ethereum, it's up 20% in like 3 days. We'll take that, won't we?
Wow. Yeah.
And we bought it beforehand. And the reason we bought it is because the signal said to buy it. Would you rather have a 20% gain or take that amount and get like 0.25%?
Yeah.
So we're talking about the total return. Did you have any questions or thoughts?
Well, I guess we're just a couple of minutes left. So we've talked about how would Yale's endowment, what does that have to do with somebody retiring here in Central Virginia? What lesson do we learn?
That's a great question, because part of it is I just wanted to take a break. I just felt like talking so much. What you need to do is you don't manage the portfolio to a yield number. You manage it for its purpose. And what I mean by that is if you say I have $1 million and I need $40,000 worth of income a year, you divide that by 12, and that's what you get a month. You don't focus on trying to generate the income, because then you get all kinds of risk. You don't try to focus on growth. What you do is you focus it according to what the market gives you, what the economy gives you. Mary, we all have our favorite foods. We all have our clothes that we enjoy that are comfortable. But we don't wear our clothes or eat all the time according to what we are comfortable with and want. Sometimes the situation, we go to a business lunch, we go to a wedding, we go to a funeral, we go to a date night with our significant other, we're going to dress differently and eat differently. And so you eat and dress according to what's going on in life. Same thing with your portfolio. You manage it according to what's happening with the market and the economy. And so finally, folks, what you need to do is remember that your portfolio is living and breathing, and you should really focus on your spending policy, your investment policy, and not just income and not just growth. So folks, some of you are sitting there, well, what do I have? What's my portfolio look like? Give me a call, 434-316-0246. Hope you have a blessed weekend, and I'll catch you next week.
This is not a suggestion to buy, sell, or use a platform. Only will a suggestion occur after a meeting to determine goals, risk tolerance, and time horizons. Investments involve risks and no guarantee of future results.